There are moments in markets when the surface looks irrational because the different parts of the system are no longer moving together. Stocks are near all-time highs. Bitcoin is rising. Housing activity begins to show signs of life in certain places. Asset prices feel like they are melting upward, and at the same time, ordinary people feel terrible. They look at grocery prices, energy prices, job uncertainty, rent, mortgage rates, insurance, and the cost of living, and they do not feel wealthy at all. That is the strange condition of this moment. Wall Street is looking forward. Main Street is living through today. Those are not the same thing. If you do not understand that difference, you will look at the market and conclude that it makes no sense. But markets do not exist to reflect your current comfort. They exist to discount future expectations, liquidity, earnings, policy, inflation, and human behavior. That is why markets can rise when people feel bad. That is why markets can fall when the headlines sound good. And that is why trying to perfectly time these turns is usually a mistake. The source story begins with a very strong claim: we may be entering a melt-up. A melt-up is not a normal rally. A melt-up is when asset prices rise quickly because people begin to feel that they are missing out. It is often driven by liquidity, momentum, optimism, fear of being left behind, and the belief that the future will be better than the present. It can be profitable. It can also be dangerous because a melt-up often happens late in a cycle when people feel rich right before the bill comes due. That is the tension. On one side, the market is rallying strongly. On the other side, inflation is not solved. Oil is rising. Rate cuts are being pushed further into the future. Consumer sentiment is weak. Housing is uneven. Political and central bank uncertainty remain. A person looking only at the rally may become reckless. A person looking only at the problems may sit out and miss the rally. The investor's job is to hold both truths at the same time. This is hard because the human mind wants one clean answer. Bull market or bear market, safe or dangerous. Buy or sell. Crash or melt. But reality usually operates in probabilities, not certainties. So let us start with the central problem. Inflation. Inflation is not only a number released by the government, it is a pressure that moves through the entire system behind many price tags. Sits one important input: oil. Oil does not only power cars, it moves cargo ships, trucks, planes, tractors, factories, packaging, plastics, fertilizer, and many parts of the supply chain. When oil rises, it can push costs higher across many areas of the economy. That is why energy prices matter so much to the Federal Reserve. A rise in oil can create inflation pressure even if other parts of the economy are slowing. It can make the central bank's job much harder. If inflation is still too high, cutting interest rates becomes riskier. If the Fed cuts too early and inflation reaccelerates, credibility can be damaged and long-term rates may rise. The source makes the argument that oil moved sharply higher from much lower levels to above $100, and that such a move could add meaningful pressure to inflation. The exact numbers matter less than the mechanism. Higher oil can mean higher inflation expectations. Higher inflation expectations can mean fewer rate cuts. Fewer rate cuts can mean higher borrowing costs. Higher borrowing costs can affect housing, consumers, companies, and asset valuations. This is one of the causal chains investors must understand. When people talk about the Fed canceling rate cuts, they are really talking about the central bank being trapped between two risks. If it keeps rates high, it can slow the economy, weaken housing, pressure borrowers, and eventually increase recession risk. If it cuts rates too soon, it can reignite inflation, weaken confidence in the currency, and force an even harder response later. That is not an easy choice. Markets, however, often move before the policy choice becomes clear. That is what makes this period so difficult. Even though the Federal Reserve has paused or frozen expectations for rate cuts, stocks have still rallied strongly. The source describes a sharp move, a rapid rally, oversold to overbought in a very short period, and the Nasdaq rising for many days in a row. This is not normal market behavior. It is extreme momentum. When markets move from fear to optimism quickly, many investors get trapped. The people who sold near the bottom waiting for clarity suddenly watch the market move without them. They then face a second emotional problem: whether to chase after the move. This is how markets punish both fear and impatience. The market rarely offers clarity at the bottom. At the bottom, the news looks bad. Oil may be high, inflation may be sticky, the Fed may sound restrictive. Consumer sentiment may be terrible. People may be saying the economy is broken. That is why prices are lower. By the time clarity arrives, prices are usually higher. That is one of the most important lessons in investing. The best prices often appear when the world feels uncertain. The safest feeling often appears after the price has already risen. This does not mean you should buy every dip blindly. It means you should stop believing that emotional comfort is the same as investment safety. Comfort is often expensive. Discomfort is often where opportunity begins. Now look at the contradiction between the stock market and consumer sentiment. The market is near highs, while consumer sentiment is extremely weak. That seems strange until you remember what each one measures. The stock market looks forward. It tries to discount what investors believe: corporate earnings, margins, liquidity, policy, and growth, will look like 6, 12, or 18 months from now. Consumer sentiment looks at lived reality. People feel today, S grocery bill, today S rent, today S mortgage rate, today S gasoline price, today S job insecurity, today S insurance premium. So when stocks are rising and consumers feel bad, it does not necessarily mean one side is lying. It may mean they are measuring different time horizons. Wall Street is betting on tomorrow. Main Street is absorbing today. That gap can become politically and socially dangerous. But as an investment signal, weak sentiment is often interesting. Historically, when sentiment is very low, future returns can be better because so much pessimism is already reflected in behavior. People are cautious. They hold cash. They sell risk assets. They delay spending. They stop believing in the future. When sentiment eventually improves, money can flow back into assets. That is part of what can fuel a melt. But again, there is no guarantee. Low sentiment can be a contrarian signal, but it can also reflect real stress. If the stress becomes recession, earnings can fall. If inflation remains high, valuations can compress. If policy stays tight, financial conditions can bite. The investor must think in ranges, not certainties. Now, another major piece of the source story is Bitcoin. Bitcoin often behaves as a speculative risk asset, a liquidity asset, and a hedge narrative all at once. That makes it difficult to categorize. Sometimes it trades like high-growth technology. Sometimes it trades like a monetary alternative. Sometimes it trades like pure momentum. The source notes that Bitcoin rose alongside stocks during the rally and that institutional flows into Bitcoin ETFs were improving. It also mentions that large financial institutions are building cryptocurrency-related products and that rising national debt encourages some investors to look for alternatives to the dollar system. This is the important point. Bitcoin is not only a price chart, it is also a response to trust. When government debt rises, deficits grow. Currencies are debased and people become skeptical of monetary policy. Some investors look for assets outside the traditional system. Gold has historically served that role. Bitcoin is increasingly viewed by some investors as another version of that idea, though, with much greater volatility. But volatility must be respected. A 30% drawdown in Bitcoin is not unusual. It can be painful, it can shake conviction, it can force weak holders out. The source describes how buying when Bitcoin was weak turned out well over the following months, but also acknowledges that it could have gone the other way. That acknowledgement is important. A good outcome does not prove a good process by itself. The process matters. If you size Bitcoin modestly within a portfolio, understand the volatility, and accept that it can fall dramatically, then it may serve as an asymmetric allocation. If you go all in because of excitement, you are not investing. You are gambling with a story attached. The source mentions keeping Bitcoin exposure below 15% of a portfolio. That is the kind of sizing discipline that matters. Whether the exact number is right depends on the person, but the concept is correct. An asset can be interesting without becoming your entire financial life. This is one of the biggest mistakes in speculative markets. People confuse belief with sizing. You can believe in an asset and still size it prudently. You can be optimistic and still manage risk. You can buy weakness and still know you might be wrong. That is investing. Then there is housing. Housing is the most emotionally charged asset for many households because it is both a place to live and a major financial decision. The source points out that national home prices may be rising slightly year over year, but forecasts are becoming more cautious. Some forecasts expect flat national prices over the next year. Other forecasts expect modest gains. The differences depend heavily on region. This is important because there is no single housing market. There are many housing markets. The West Coast may behave differently from Texas or Florida. The Sunday Belt may behave differently from the Northeast markets that had the largest price run. Ups may now face the largest pressure because affordability is broken and inventory is rising. More affordable northern markets may see more support because buyers are relocating or searching for value. Housing is local. National averages hide local realities. The main driver remains mortgage rates. Higher oil can feed inflation expectations. Higher inflation expectations can keep interest rates elevated. Higher interest rates keep mortgage rates high. Higher mortgage rates reduce purchasing power. This is the chain. A buyer does not buy a house price in isolation. A buyer buys a monthly payment. When mortgage rates are high, the same home price produces a much higher payment. That means prices either have to stagnate, fall, or incomes must rise enough to support the payment. If mortgage rates fall modestly, it helps, but not always enough. The source mentions that even a decline in mortgage rates to around 5.7% by 2030 would only increase purchasing power modestly. The point is that a small rate improvement may not solve an affordability crisis created by very high prices. This is why housing may remain uneven. Some sellers will have to negotiate. Some markets with too much inventory may soften. Some buyers will stay on the sidelines because there is no urgency. Some owners with low-rate mortgages may choose not to sell. Limiting supply in other markets, some regions may still rise because supply is constrained and demand remains strong. Again, There is no one clean answer. The housing market is not simply bullish or bearish. It is segmented by location, supply, affordability, mortgage rates, migration, wages, and inventory. A good investor or buyer must understand the local conditions. Now let us return to the Federal Reserve. The source says that there are no rate cuts for the foreseeable future because of ongoing inflation concerns, rising prices, weaker consumer spending, and labor market fragility. It also frames this as a transition moment with Jerome Powell near the end of his role and Kevin Warsh expected to take over. Whether any specific date or personnel change unfolds exactly as described, the deeper issue is the uncertainty created by monetary leadership and policy direction. When a new Fed chair enters, markets have to reprice expectations. Will policy be more restrictive or more accommodative? Will the balance sheet shrink faster? Will independence be preserved? Will political pressure push for lower rates? Will inflation credibility be protected? Will liquidity tighten or ease? These questions matter because asset prices are highly sensitive to liquidity and interest rates. The source also notes that historically, new Fed chairs have sometimes taken office near periods of market weakness. I would not treat that as a law. History can inform, but it does not mechanically predict. The more important point is that transitions increase uncertainty, especially when valuations are high and the economy is fragile. The market may want lower rates. The Fed may not be able to deliver them if inflation is hot. Politicians may want easier money. The central bank may need to defend credibility. Investors may expect support. Bond markets may demand discipline. These forces can conflict. When forces conflict, volatility tends to rise. That is why trying to be too clever in these periods is dangerous. The source eventually comes back to a simple conclusion. Every time you think you know what the market will do, the market humbles you. That is one of the most valuable lessons in finance. You can have the right data and still get the timing wrong. You can understand the economy and still misread the market. You can see inflation risk and still watch stocks rally. You can see recession risk and still watch Bitcoin rise. You can see housing weakness nationally and still find local markets rising. The market is not a machine built to reward your certainty. It is a machine built from millions of participants, each with different time horizons, incentives, information, leverage, and emotions. That is why consistent long-term investing often beats tactical overconfidence. If you sell every time the world looks scary, you may miss the strongest rallies. The source mentions that people who sold in April missed one of the fastest rallies in history. That is how quickly markets can turn. The same principle applies to Bitcoin. People waiting for a lower price may miss the recovery, then they feel pressure to buy higher. Markets often make you feel maximum fear near opportunity and maximum confidence near risk. That is why a systematic approach is powerful. Decide how much you can invest regularly. Choose an allocation you can live with through a 30 to 50% drawdown. Then continue investing consistently. This does not mean ignoring risk. It means building a system that does not depend on predicting every short-term move. The phrase "stay the course" can sound simplistic, but it is difficult because staying the course is emotionally hardest exactly when it is most valuable. When markets fall, the mind wants to stop. When markets rise, the mind wants to chase. A good system reduces the need to make emotional decisions. Dollar cost averaging is one such system. You invest a fixed amount regularly regardless of price. When prices are lower, you buy more shares. When prices are higher, you buy fewer. Over time, the method helps you avoid the psychological burden of deciding whether today is the perfect entry point. It is not perfect, it does not guarantee profit, it does not prevent losses, but it helps solve the biggest problem most investors face themselves. The enemy is not always the market. Often the enemy is the emotional investor reacting to the market. Now, a melt-up presents a special problem. If the market keeps rising, people who were cautious begin to feel foolish. They begin to abandon discipline. They increase risk at higher prices. They buy what already moved. They forget that drawdowns are normal. They assume momentum proves safety. That is how late cycle losses are created. So if this is a melt-up, the right response is not to panic buy everything. The right response is to participate with discipline. Own quality assets, maintain diversification, do not use leverage, you cannot survive. Keep liquidity, continue your plan. Rebalance if allocations become too extreme. Avoid being all cash out of fear, but avoid being all in because of greed. This balance is hard, but it is necessary. If you are too defensive, you risk losing purchasing power and missing gains. If you are too aggressive, you risk being forced out during a sharp reversal. The right allocation is the one you can hold through both euphoria and panic. That is more important than what looks optimal on a spreadsheet. An optimal allocation that you abandon at the bottom is not optimal. A slightly imperfect allocation that you can actually hold is often better. This is why temperament is part of investing. Now, what does this mean for the major asset classes for stocks? It means the rally can continue even if the current economy feels weak because markets discount future growth, liquidity, and earnings. But high valuations and inflation risk mean future returns are not guaranteed. You should own stocks if they fit your long-term plan, not because the last 10 days were strong. For Bitcoin, it means institutional adoption and debt concerns may support the long-term narrative, but volatility remains extreme. Size it so you can survive deep drawdowns for housing. It means do not rely on national averages. Study your local market, inventory, affordability, seller behavior, mortgage rates, and your personal time horizon. Buying because you fear missing out can be dangerous when affordability is stretched. Waiting forever can also be costly if your local market remains tight. For cash, it means liquidity is necessary, but excessive cash can be dangerous. If inflation continues, cash gives optionality. It does not guarantee purchasing power for bonds. It means the rate environment matters. If inflation stays sticky, long-duration bonds can be pressured. If recession hits, bonds may help. Understand what role bonds play in the portfolio for personal finance. It means the same old principle remains. Do not build a plan that requires perfect macro prediction. Build a plan that survives uncertainty. That is the core. Most people want to know what will happen next. Will the Fed cut? Will stocks crash? Will Bitcoin reach a new high? Will housing fall? Will oil keep rising? Will inflation return? Those are reasonable questions, but no one knows the answers with certainty. The better question is this: what should I do regularly that makes sense across many possible outcomes? That is where disciplined investing wins. If markets continue melting up, your regular investments participate. If markets fall, your regular investments buy lower prices. If inflation persists, ownership of productive and scarce assets may help protect purchasing power. If recession comes, your emergency fund and diversification protect you from forced selling. If rates stay high, you adjust debt decisions and housing decisions carefully. If rates eventually fall, you benefit through assets and refinancing opportunities where appropriate. The goal is not to predict one future. The goal is to be reasonably prepared for several futures. This is how I think about this market. There are real reasons to be cautious. Oil-driven inflation risk, no near-term rate cuts, consumer weakness, housing affordability problems, policy uncertainty, a potential new Fed regime, high valuations, speculative momentum. There are also real reasons markets may keep rising forward: looking earnings, institutional flows, AI optimism, Bitcoin ETF demand, low sentiment that can reverse, liquidity expectations, the belief that any slowdown will eventually bring support. Both sides exist. So I do not want to be paralyzed by risk, and I do not want to be blinded by momentum. I want a system, a monthly investment plan, an allocation I can live with, a cash reserve for emergencies, no high-interest consumer debt, exposure to productive assets, some diversification beyond one narrative, a willingness to rebalance, and humility. Humility matters because the market has a way of punishing people who confuse a correct recent call with permanent insight. One tweet can change sentiment, one inflation print can change rate expectations, one oil shock can change the Fed's path, one earnings report can change a sector, one liquidity event can change the market, one policy shift can change the whole narrative. That is why overconfidence is expensive. If you build a plan that requires you to be right every month, the plan will likely fail. If you build a plan that can survive being wrong often, you have a much better chance. The investor who survives is the investor who does not need to know exactly what happens next. That is the difference. The source makes the point that every time it feels obvious, the opposite can happen. When everyone believes Bitcoin is finished, it may rally. When everyone believes it can only go up, that may be the dangerous point. When everyone sells stocks waiting for clarity, the market may rally before clarity arrives. When everything looks safe, risk may be building. This is human nature. Markets are not only fundamentals, they are fundamentals filtered through human emotion. Fear pushes people to sell low. Greed pushes people to buy high. A disciplined system protects you from both. That is why I would not approach this melt-up with either panic or blind enthusiasm. I would approach it with rules. Continue investing. Do not overconcentrate. Do not chase after parabolic moves with money you cannot afford to lose. Do not abandon long-term assets because inflation headlines scare you. Do not assume the Fed will rescue every mistake. Do not assume no rescue is coming either. Watch oil. Watch inflation expectations. Watch earnings. Watch credit conditions. Watch employment. Watch housing inventory. Watch liquidity. But do not let watching become paralysis. There is always something to worry about. If you wait for a world without risk, you will never invest. And if you invest as if risk does not exist, you will eventually be taught a painful lesson. The right path is to invest while respecting risk. That is the only path that works over long periods. Now, let us bring the whole sequence together. Oil rises and inflation risk rises with it. Inflation risk reduces the probability of near-term rate cuts. Fewer rate cuts mean borrowing costs stay high. High borrowing costs pressure housing and consumers. But stocks rally anyway because the market is forward-looking, momentum is strong, and investors may believe earnings and liquidity will improve. Consumer sentiment remains weak because ordinary people feel current prices, not future earnings. Bitcoin rises as risk appetite returns and institutions allocate through ETFs. Housing becomes regionally divided because affordability, inventory, and migration differ by market. The Fed faces a difficult trade-off between inflation control and economic support. A leadership transition or policy shift adds uncertainty. The investor who tries to trade every twist may be whipsawed. The investor who builds a durable plan can use volatility rather than be controlled by it. That is the structure. The most dangerous conclusion would be, everything is fine because stocks are up. The second most dangerous conclusion would be, everything is terrible, so I should hold only cash. Both are too simple. Stocks can rise in a fragile world, cash can feel safe while losing purchasing power. Inflation can hurt consumers while supporting nominal asset prices. Rate cuts can be delayed while markets rally. Housing can fall in one city and rise in another. Bitcoin can be risky and still rise. The world is not one-dimensional. Your strategy should not be one-dimensional either. If this is the beginning of a melt-up, you want participation. If this is late-cycle euphoria, you want risk controls. That means you need both offense and defense. Offense is owning productive and scarce assets that can benefit from growth, liquidity, and inflation. Defense is liquidity, diversification, no toxic debt, and position sizes you can hold during drawdowns. Most people choose one. Serious investors need both. That is how you come out ahead. Not by predicting the exact Fed meeting, not by knowing the exact oil price next month, not by guessing the next Bitcoin move, not by timing the housing bottom, by building a system that turns uncertainty into something you can live with, a system that keeps you in the market without letting the market control your emotions, a system that lets you buy when fear returns, a system that prevents you from getting reckless when prices rise, a system that recognizes inflation risk without becoming paralyzed, a system that treats rate policy as one input, not the whole game. This is why I keep coming back to consistency. Decide how much money to invest every month. Build an allocation that you can tolerate through real drawdowns, understand what you own, stay diversified, keep learning. Do not stop because of one Fed statement. Do not chase because of one rally. Do not let headlines define your plan. The market will keep trying to make you feel stupid. When you hold cash, it will rally. When you buy, it may fall. When you sell, it may recover. When you feel certain, it may reverse. That is normal. The only way through is to stop needing perfect timing. If the melt-up continues, you participate. If the market falls, you continue buying at lower prices. If inflation stays high, your real assets and equities may provide some protection. If recession arrives, your liquidity protects you. If Bitcoin rises, your modest allocation participates. If Bitcoin falls, it does not destroy you. If housing stays flat, you avoid rushing. If housing becomes attractive, you act from strength. This is not exciting. It is resilient. And resilient is what matters. Because the last phase of a cycle can make everyone feel rich. Then the bill can come due. If that happens, the people who use the melt-up to become reckless may suffer badly. The people who used it to strengthen their balance sheet, stay invested, rebalance, and maintain discipline may come out stronger. That is the goal. Do not be the person who sells the bottom because the news is frightening. Do not be the person who buys the top because the rally feels unstoppable. Be the person with a system. That is how you survive markets like this. And survival is what allows compounding to do its work.